Well, hello, everyone. Thomas Montgomery back with you. We are on the topic of banking and money today. This is the fourth of four modules in our small business certification. So most likely you've gone through three others already. About 3 weeks ago, you most likely went through the business planning lesson, where we talked about the four phases of planning for a small business. And then afterwards, we should have helped you start building out your business plan with financial projections. The second week was on credit, where we learned about business credit versus personal credit. And at that point, one of our financial literacy educators should have worked with you on a couple tasks, including building out your personal financial statement. The third week, of course, is on financial management, which dovetails nicely into this topic. And afterwards, we should have worked with you on your financial needs analysis and your collateral assignment. So here we are in the fourth of the final weeks of the 4-week curriculum. Remember, this curriculum was developed by the FDIC. It's promoted by the SBA. And our nonprofit, the IIMFL, the Institute for Improved Minority Financial Literacy, was exclusively selected to administer this to help improve financial literacy and access to capital. We're so thankful that we've had the opportunity to work with you through this 4-week curriculum, and we do encourage you to help spread the word. If you know of other small business owners that could benefit from this, we have a really nifty affiliate program. Doesn't cost anything to be an affiliate. Of course, you can spread the word and get paid for doing so. The model, as you've likely seen, is each week during the 4 weeks, we teach a lesson and then we work with you on implementing that lesson. And that's going to be true for this week, the 4th week as well. There are a couple resources that you need to be aware of for the 4th module on banking and money. We have this YouTube recording that you're listening to now. We love to go out and teach this in person. And in many cases, we'll teach all 4 lessons in just one day at churches, chambers, and so forth. So if you know of any organizations that we might be able to go out and teach in person, we would, but otherwise we offer it online here in the YouTube format. There's a participant's guide that is very helpful for you to have. So if you don't have that yet, you may want to pause this recording and get that from us, request that from us, from your financial literacy educator. The participant's guide will give you some supplementary information, but also there's some checklists, the evaluation, the assessments are all part of that guide that you wouldn't see all that here on the screen. And then, as is our model, we don't want to just talk or teach. We want to help you actually implement and, of course, answer questions that you have. So your financial literacy educator is important in that process. And afterwards, he or she will be working with you on your capital match. Because now that we've gone through the 4 lessons, we're ready to assemble everything and determine what is the right type of capital based upon your circumstance. Now, certainly today we'll be talking about types of capital. To the right of your screen, you see that there are so many other modules that we teach. There's a total of 13 modules in the Money Smart for Small Business curriculum. Is owning a business a good fit for you? Planning for a healthy business, which is module 1. Banking services, which we'll include today. Organizational types, trying to figure out, should I form an LLC, C Corp, or S Corp? Time management, financial management, which is for module 3, record keeping, business credit, which we cover in module 2, risk management, insurance, tax planning, selling your business, and managing cash flow. So lots of great topics that we'd be happy to assist you with. So our agenda, we're doing the welcome now. We have a pre-survey, and you'll find that in your participants guide, and we're going to review our learning objectives here together in just a moment. There are 3 sections to this lesson. However, due to time management, we're not going to go through all 3 fully. So let me explain. We're going to go through section 1, banking services, and there's an exercise associated with that called What Banking Services Do I Need? Section 2 is on financing options and sources. There's 2 exercises there, a financing checklist and a readiness checklist. That readiness checklist is really the most important to me, and we'll actually be reviewing that, or your financial literacy educator will be reviewing that with you. Section 3 you have in your participants guide. You can go through it if you want. For time management, we won't go through it today together, and then we'll wrap it up. Okay, so let's go ahead and get started with section 1, because again, we're going to cover sections 1 and 2 together today. Section 1 on banking services. We'll talk about building a banking relationship, factors in selecting the right bank, talk about some different types of account services and other services that at least I want you to know about. These may or may not be applicable to you, but at least we want to give you an awareness of what some of these services and resources are that are available through banks for small businesses. So when it comes to building your banking relationship, we encourage you to meet with your bank staff, get to know them so they know you. And that makes sense. And so often when we're working with small businesses and raising capital, we prefer to work with the bank that the client already has a relationship with, or if there's not a fit there, to go go open a checking account with the bank before we actually apply for funding. That's a best practice. And I could give you many examples of that, but I'll spare your time. But it makes a difference. Now, I realize that we live in an increasingly online virtual world, and you may even work with a bank that has no physical branches, so you don't have a relationship with a banker. But in most cases, if you can meet with them, you know them, they know you, then we'll probably have a better relationship. There are some myths about banks that aren't necessarily true. Let's go through those briefly. First, banks don't want your business because you're too small. That's not the case. And for most banks, they have business bankers, and those business bankers have goals every month. And one of those goals is how many loans have they been able to facilitate? Or even more simply, how many business checking accounts have they opened? So there's typically a great interest in business bankers in getting to know you and work with you and help your business, because it helps them with their business. It helps them meet their goals as well. Secondly, that banks don't want to make small loans is the second myth, and that varies very much by business. What we've learned is that there are some lenders that are better fit for different circumstances. So some are more accustomed to doing smaller loans, some larger, some SBA guaranteed, some not. So there certainly is a bit of a puzzle there that we'll help you put together. Third, that you need a perfect credit history, and that's not true at all. We're seeing the ability to get bank loans from businesses or from lenders with credit scores as low as in the 500s. And so better credit is obviously better, but we always have to remember there are different sources of capital. Each have their own underwriting criteria, but don't think that you have to have perfect credit history to raise capital. Loan applications take months. Certainly, different types of loans can have different types of underwriting requirements and different lengths of processing, but it doesn't always have to be long and drawn out. And lastly, that the fees are not affordable. We'll talk more about fees as we go through today's lesson. Things to consider. Well, what banking services do you need? And what should you look for when choosing a bank? In your participants guide, there is a banking services needs checklist. I believe it's on page 11, and you could take a look at that and fill that out, and that might help you get a better grasp of banking services needs that you have. So what are some factors in selecting the right bank? Customer service. And customer service could not only mean how nice they are to talk to, but are they accessible? I've heard and I've personally experienced Some banks, you have a 1-800 number is the only way to reach someone, and you call in and you're on hold forever, and it can just be very difficult to do business with them. Now, you need to define what level of customer service you want and you expect, but certainly there is a difference between banks and customer service. How accessible is your money? And there are different ways that you can transfer and access funds. So it's not all the same. And so that's what you'll want to visit with prospective bankers. The way that we see it is that you should be picking your bank. It's their benefit of having you select them to work with. And so you can schedule a couple appointments with business bankers and almost interview them to decide which bank do you want to bring your business to. In terms of technology, we've seen rapid growth in online banking with the ability to take pictures and deposit remotely and so forth. Depending upon your business needs and preferences, technology may play a role. And then certainly there are some that have some specialized products, programs, services, and offerings targeting small businesses. And so we're independent. We're not here to advocate for you to go work with a specific national bank or community bank. That's a decision that you need to make. What we're trying to do here is to give you some points, some ideas, some factors to consider. You may have heard of FDIC, and of course FDIC is a key contributor to this educational curriculum, but unrelated to that, the FDIC has deposit insurance. And so let's talk about that for a moment. Coverage for the deposit insurance is per depositor. A depositor may be a person or a business, including nonprofits. The standard insurance amount is $250,000 per depositor. Now you might say, well, this seems kind of irrelevant. We're not in 1918. We're not going through the Great Depression. I can't imagine that a bank would go out of business. But certainly there have been banks that have gone out of business even over the past couple decades. And the FDIC helps regulate that and provides this insurance. So if the bank were to go out of business, you wouldn't lose your money up to certain requirements. Now you'll see the note in the bottom right-hand corner. Credit unions are certainly another option. They don't fall under FDIC. They fall under NCUA. And so those requirements will differ. When it comes to banking services, there's lots of different account services that banks may offer. And let's just briefly go through these, and I want to emphasize a couple. So business checking accounts. We've talked about it is crucial that your business has a separate checking account. And you may even decide to have multiple checking accounts for your small business. You might have one for payroll and one for an operational fund. That's up to you. But at least you need to have a business checking account. There's no question that's non-negotiable. Business debit cards, of course, are a way to be able to pull money out to pay for business transactions conveniently without paying by check. Savings accounts are often overlooked. Savings accounts are really good because it looks to the external eye, to lenders' eyes, that you have a plan and a vehicle to actually save and grow money separate from just day-to-day transactions. So we do encourage everyone to have a savings account. Certificates of deposit is another way of saving and growing money. However, it's less liquid, and you can talk to your banker about that. Many banks will offer retirement and other employee benefit accounts. Business credit cards are great because we've talked about so many times that we need to separate our personal financial transactions from business. And so we should pay for business expenses out of the business funds, whether it be a business check, a business debit card, or here, a business credit card. Payroll services are so important, and you may want to go through your bank or third party for that. But we talked about this in the last lesson, the third lesson, lesson 3 on financial management. we encourage you to not be self-employed. And that sounds strange, but what that means is pay yourself a salary through your business. And so if you're going to do that, most likely you're going to want to work with some sort of payroll service provider that can help automate that, help with record keeping, help with compliance, with the tax submission. And so payroll services is something that we strongly feel needs to be on your agenda of things to set up if you've not done so, and your bank may be the resource provider for that. Cash management, you may say, well, what is that all about? Or I don't have that much cash to manage, but that can be as simple as ACHs. You may want to collect money from clients via ACH or be able to pay bills with online banking and so forth. Merchant services is related to accepting credit cards. In today's environment, it's very common to allow your clients to pay you by credit cards, whether it be MasterCard, Visa, American Express, Discover, or others. And so you need some mechanism to do that. And I can tell you, and we'll get into it a little bit today, but in individual conversations, that credit card deposits, a history of credit card deposits coming into your business can in fact be a form of collateral. So that's very valuable. And then other services they may offer as well. Again, we're not associated with any given bank. We're independent. We don't advocate for a given bank, but this is a checklist of account services that maybe you hadn't considered that you needed, but may be helpful as you start and or grow your business. Now, to no surprise, in the business world, there's going to be fees for things. And so cost of transactions and services through a bank is going to be relevant. You should look at their fee schedule to understand what those fees are. And they also will provide you account disclosures. And in many cases, you can reduce or eliminate fees based upon certain volume. So that's why it's important not only to choose your bank, but to choose, for instance, the right type of banking account based upon the amount of transactions, average daily balances, and so forth. Timing, ease, and security of payment transactions. Most payment transactions do not occur in real time. Writing a check or initiating a bank transfer when you don't have the funds available can be very costly. So things that you should be aware of are direct deposits. I made reference to ACHs, which stands for Automated Clearinghouse Debit, credit card processing, debit block, lockbox services, and others, as well as the remote deposit capture we talked about a moment ago, where you can take a picture with your phone or your smart device. You don't literally have to go to the bank to deposit that check. More on account services, business checking accounts. Some important considerations include the transaction volume may determine the best account type, and you may change that as your business grows. You need to know federal, state, and contract rules regarding governing checks. Banks use information systems to evaluate applicants. And so we've talked about back in lesson 2 about credit agencies, and we said that there are 3 main credit agencies for businesses and 3 for for individuals. But above and beyond that, there are other types of agencies that track activity, and one of those is check systems, the bullet we're on now. And so if you've not done a good job in managing your banking relationships in the past, you may have a derogatory status within check systems. For instance, it showed that your account closed with a negative balance. And so, but not all banks use check systems, I'll make comment of, but there are some banks that have second chance accounts for those who have had problems before. More on account services, talking about business debit cards. It is valuable to be able to pull money from your business account, of course, for business expenses. And if we're in a position where we can't qualify for a traditional business account with a traditional debit card, some banks will even offer a preloaded card that can be used for yourself or could be given to your employees or others, so that you have limited exposure, but they have the ability to cover expenses, for instance, when they're traveling or out buying supplies for your business. Account services, there's different types of accounts, such as savings accounts. And as I mentioned before, I think this is a really good practice to have both as an individual and as a business. Don't think about just opening a checking account. Also, please consider having a savings account. Savings accounts aren't designed to have as many transactions in and out of. They often will have a higher earning rate. But frankly, in today's environment, the earning rate, because our federal government is setting interest rates so low, prime rates so low, the cost of borrowing right now is very affordable. Mortgage rates are some of the lowest in history, but our money doesn't grow much in normal bank accounts. So while savings accounts do have typically a higher interest earnings rate than a checking account, it's pretty much immeasurable right now. And then certificates of deposits, as we've talked about, certificates of deposit are often going to have a lock where you can't access those funds for 6 months, 12 months, or longer in exchange for higher earnings. But those earnings are so low right now, I don't know that certificates of deposit are a good vehicle to use. Additional banking services, payroll services. We've talked so much, so many times about that you want to pay yourself a paycheck, and it can actually, I should say, reduce your employment taxes, not increase it. And so this is important, especially if you have employees where they can get paid direct deposit. We don't want to fall into the trap of paying everyone cash or off the record. That's not compliant. And now that's going to be much more difficult to deduct that if you're audited. So we want to treat a business and run a business properly, and having payroll services is most likely part of that. And as I mentioned earlier, we may even want to have a different account that we use for our payroll account. Additional banking services. We can manage cash by discussing options with your bank, certainly keeping detailed records, reporting all of your cash income. I work with so many small businesses of different industries, and some of them have a lot of cash transactions. And if you're running your business properly, you're reporting that, and typically you're going to make cash deposits into your bank account. Just because a client pays you by cash doesn't mean that we shouldn't record it in our QuickBooks or in our financial software, and it doesn't mean that we shouldn't deposit it in the bank, and that it shouldn't be included in calculations for income tax. That may be tempting, but that's not the legal or proper thing to do. We can increase sales by using merchant services, such as accepting credit and debit cards, as we've talked about, and you can receive credit and or debit card payments off of your website or even in person with point of sale terminals. Some businesses see value in offering gift and prepaid cards. I'm commonly amazed. You'll walk into grocery stores and Walmarts, and they'll have these turnstiles with all these different prepaid cards from Olive Garden and Best Buy and Amazon and Apple and so forth. But you may not have realized you can actually have gift or prepaid cards set up for your business as well. Not only for your logo, with your logo on it, but also for customers to use for payments with your business if relevant. Accepting online payments and orders. Certainly, as we've had all the economic changes that's occurred in 2020, where online transactions are at an all-time high, and if you're not involved, if relevant for your business, if you're not making it easy for clients to buy from you online, you may be missing out on a significant part of your target audience. Additional banking services. We talked about this some in lesson 3. And we need to be using QuickBooks or something like that, a software like that, to record our income and expenses, but we also need to reconcile our accounts at least once a month. Then you work with your bank to address any discrepancies or suspicious activity. You want to verify the amounts paid for checks within the amounts that for the amounts that you wrote them for. Retain reports from remote deposit scanner software. So what's the point? We don't want to just have a bank account. We don't want to just use our business bank account for business services. We need to reconcile, which means confirm and check off in a more formal manner that what came out of our bank account is what should have come out. Key points to remember. You need to build a banking relationship as early on as possible. You should feel like that you're in charge and choose a bank based upon its resources, spreading across customer service, technology, and the services they offer for small business. You need to ensure the ways to access your funds and transactions are secure. Consider the features and risk associated with savings and checking accounts and business debit cards. Increase your business efficiency through banking services such as payroll, cash management, and merchant processing. And then we just talked about reconciling your accounts. Okay, so that was section 1. We're going to go through just 2 of the 3 sections. So we're on the downhill slide here. So thank you for sticking with me. Let's go through section 2. And I think you're going to find section 2 probably more interesting. I'm not saying it's more important, but I think you'll probably find it more interesting and very relevant as we're preparing to get ready to put together your capital match so we can help you get the funding that you need. All right, so financing options we'll talk about, financing sources, and financing readiness, including the 5 C's of credit. We've addressed before, there are different sources of capital and each have their own underwriting criteria. So please do not think, oh, I don't qualify for funding. This isn't going to work. No, there's different types of funding. Half the battle is finding the right type of funding for your circumstance. Furthermore, we've previously in prior lessons talked about that there's debt-based capital and equity-based capital. Here we're focused more on the debt-based, and that's where the 5 C's come in, and we're going to review those again today here in a minute. We have a loan readiness checklist, which I really like, and it's something we're going to ask you to complete, and then your financial literacy educator is going to review that with you. We're going to understand that there's always going to be a cost of capital. Don't get in the mindset, don't fall into the mindset that you're looking for free money. There's not going to be free money in most circumstances for for-profit businesses. There's always going to be a cost of capital. So we're going to talk a little bit about the cost of financing today. So we see here 5 circles, 5 different financing options, and we're going to have a slide or more on each one of these. We'll talk in the top left-hand corner about savings, gifts, and informal loans, and then center top, term or installment loans, top right, lines of credit and credit cards. To me, lines of credit and credit cards operate very similarly. We'll often have small business owners that say, well, you know, I just want a line of credit. I want a credit line. I don't want a business credit card. But as you dig deeper, they operate very similarly. And we've had success getting $100,000 of business credit cards for a small business. And you might say, well, that sounds terrible. Well, is it? Because really it's the equivalent of a $100,000 line of credit. If you use it, you pay for it. You don't have to use it. It's constantly available. So we'll talk about that. Bottom left, small special purpose loans, and then finally other financing options. So let's go ahead and start digging through those circles. So we're going to talk about savings, gifts, and informal loans first. This is actually the #1 form of financing used by startups because it's the least restricted. It's based upon you knowing someone that believes in you, that's willing to help you get started. Now, depending upon how that money is transferred, those gifts to you may be counted as business capital. Further, and you see the asterisk, consult with an accountant. Remember, I used to work for the SBA. So depending upon how that money is gifted to you, that could be used as a qualifying factor to be able to get an SBA loan as well. But we'll talk about that offline. Payments towards informal loans or investments by family, friends, or other individuals must be part of cash flow. So we talked about that there are 3 primary financial statements: the income statement, sometimes called profit and loss, balance sheet, and statement of cash flows. What this bullet is mentioning is that we need to reflect that incoming money into the account, into the business, deposit into the business account, and shown on our statement of cash flows. Okay, second type of financing option. So we're on a new ball here, and this is term or installment loans. There's a simple example on the left, and what it's showing is that if the loan is $1,500, then there's going to be a payment, and there's going to be a period of time until you pay it off. So term or installment loans are for a defined amount. You get that money up front, and then you have to make payments each month. So let's see some of the bullets associated with that. Just clarifying that that money is dispersed to you in a single source. So different than the business credit cards or lines of credit we made reference to before, where you can pull a little bit at a time. A loan comes all to you at once. And so now the payments start and the interest starts accruing. It has a defined period typically for repayment. And I'm going to give you some examples of repayment terms here in a subsequent slide. There's going to be interest. And so again, as a business owner, we need to get away from thinking about, well, where's the free money? There's typically not going to be free money. You have to pay it back, and there's going to be interest because that's the way the economy works. There's risk associated with them lending you money, and there's a cost associated with them lending you money. It's not going to be free money. And there can be different purposes. The purpose shown here in the slide is purchasing assets, but we see term and installment loans used for other purposes as well, including working capital. We do a lot of SBA 7A Express loans, which go up to $150,000 with a 10-year repayment term. Here it says that the asset that's being purchased is part of the collateral. I would suggest that it's actually a little more complicated than that. There's different collateral instruments that can be used. And of course, if we're using it for a working capital loan, then there's not a specific item being purchased. But when the FDIC developed this slide, I think that they were thinking that this would be used only for asset-based purchases, and that's not the case. What that also means, though, since this is a specific disbursement all at once, the underwriting is done for that. You get the money typically wired into your business account, so you need to have a business account. And if you later wanted more money, then typically a new application would have to be created, and then there would be a new disbursement. Okay, so we're on to our third ball, aren't we? We're on lines of credit and credit cards, which we talked about a moment ago. I really want you to see these as much more similar than different for the reasons I mentioned. Business credit cards, we have the ability in many cases to help you get business credit cards that are under your EIN. So oftentimes those don't even report on your personal credit. I'm not saying that there's not a personal guarantee involved, there may be, but we're saying that it's a business credit card reporting under the EIN that shows up on your business credit reports, like we talked about in lesson 2, Dun & Bradstreet, Experian Business, or Equifax Business. So you can use this money as you need, but you don't have to have any cost of capital if you're not using it. You don't need it. Now, the FDIC says this is generally secured. I will tell you that in many cases we're able to set up, it's called UBF, unsecured business financing, that's unsecured. So I don't necessarily agree with this first bullet, but it's true. The second bullet I do agree with in the sense that it's typically unrestricted funds. Usually you can use these funds for whatever you want. Now, something that people don't understand, and I'll go through this, I was visiting with an executive of BBVA Compass Bank. His name's Mark. And so we were doing a workshop together, and he clarified something that I don't think most small business owners understand. If you were to get a line of credit, so let's separate from a business credit card, but you were to get a line of credit, a line of credit is not intended for you to continuously use. In other words, a line of credit means you need it because there's a little bit of delay in a client paying you, or there's some seasonality effect or what have you in your business. But if you're using your line of credit consistently, they may close it because you should have gotten a loan. You should have gotten a term loan like we just talked about. Business credit cards aren't that way. So just keep in mind, well, so many people want to run and say, I want a line of credit, I want a line of credit. That's not often the right source of capital. And requires annual credit review and renewal based upon performance. Well, again, I don't completely agree with that from our experience. Business credit cards, there's going to be underwriting up front, but the underwriting up front for business credit cards is often preferable for many small business owners, whereby a lot of the data that they consider is just self-reported. In other words, it's not validated. You typically don't have to provide a lot of financial documentation with it. I think this bullet here was more referencing to lines of credit, and so banks are, with lines of credit, going to go through an annual review. The last bullet may seem obvious, or second to last bullet, we have one more, but the second to last bullet may be obvious, that when you open a line of credit or a business credit card, it's not like a term or installment loan like we just discussed. There's not some big wire going into your account. Instead, you pull from it as you need. But the beauty of this model is that you're only paying based upon how much you've used. Because again, if we go get you a $150,000 SBA Express loan, $150,000 or thereabouts is wired into your account, even if you don't need all that, now you're paying payments on all of that. That would be the benefit of these more flexible terms. Okay, next, on business credit cards, just talk about those a little bit more. Business credit cards can vary. Some can require full payment at the end of the month. Others are just have a minimum payment. Most of what we do, and I think there's 13 different business banks that we work with that issue business credit cards under the EIN alone. And so you can pay the balance off at the end of the month or let it roll over and just make minimum payment. The point here, I suppose, is that if you don't pay it in full at the end of the month, then there's interest expense. But you and I have already, we've cleared the air, right? There's going to be a cost of capital. We're not trying to go find free money. So with that being said, of course, there's going to be an interest expense for the money that you're rolling over. This bullet here is correct, that if we set up business credit cards correctly, then they report under the business credit, under the EIN, versus under the personal credit of the owner. And that's a good thing, because that is consistent with our key of separating business and personal financial affairs, but also it keeps your debt ratios down. We've seen small business owners that didn't properly separate and they couldn't go qualify for a home loan, for example, because they have all these business related expenses and debts showing on their personal credit report. I'm going to separate that as much as possible. And then we can even get authorized users involved, but we're going to talk about that today. All right, so there are special purpose loans, so we're on to the next. There's agricultural related, those specifically for manufacturing, programs for veterans and military members, specific programs for exporters. And we've seen certainly earlier this year in 2020, disaster related loans that are unique based upon disasters, floods, pandemics, and so forth. All right, there are other financing options I'd like to briefly review. Leasing, and for some reason as a society, most of us are opposed to leasing. It's like, no, I want to own it. I don't want to lease it. But for some equipment purchases, it just makes sense to lease it. So please be open-minded. Don't close the door on options that might be really a better fit. But as we put together your capital match, we'll see if leasing fits in. And leasing could be for manufacturing equipment, or it could be for a new business truck or car for your business. There is another type of financing available for financing inventory. Another that's called factoring. That means that we're selling accounts receivable for a discount to third parties. So we don't receive 100% of the monies from our clients, but we get the money quicker, which can be a lifesaver. Credit card loans or merchant cash advances. And so sometimes these get a negative rap because of their expense, but there's a variety of different instruments that fall under this bullet. And one that we've had great success with, again, is looking at credit card transactions, using that as collateral, one of the 5 C's we're going to talk about again here in a few minutes. So again, all sources of capital are going to have a cost. Each have different underwriting criteria and they have different costs. And so we want to be careful in working with you to find the right type of capital based on your circumstances. And we can even finance receivables. Let's talk about some specialized funding programs that we've been fortunate to be involved with putting together and or being distribution partners for. There is the IIMFL Small Business Loan Program. It's small, relatively speaking. The minimum amount is $20,000. It goes up to $250,000, but you see the plus there afterwards. It can exceed that, but it has a relatively small repayment term. So again, in contrast, when we're working with you on an SBA 7A Express loan, that's a 120-month repayment term. Well, when you have a longer period of time to repay it, what happens? Your payments go down. Here, this is from $20,000 to $250,000, 36 to 60-month repayment terms. We have the IIMFL Community Advantage Loan Program. Starts at $35,000, does have a hard stop at $250,000. Repayment period of 12 to 60 months. The good news on this one is it has lower credit score requirements because it's actually designed for people that can't qualify for other types of funding. And the interest rate is a very reasonable prime plus 6%. We have the IIMFL Reopen Express. This is for businesses that have been impacted by the pandemic and they're looking to reopen, has some specific requirements to it. It's $1,000 to $10,000 and interest rates start as low as 2.75. Our Restart Recovery, specifically designed to provide 2 months of working capital up to $50,000. And again, very low interest rates starting as low as 2.75. Now, there are many other options, and I hope that we've conveyed this to you. There's many different sources of capital. each have their own underwriting criteria. Chances are you'll qualify for some, not others. If there's something that you like but you don't qualify, then we can work together to meet the underwriting criteria. But there's not a magic wand. By going through this 4-week program or anything else, you don't just suddenly qualify for a bunch of money. What we're doing is educating you and building your loan package by pulling these pieces together. But at the end of the day, you have to meet the underwriting criteria. So thus, half the battle is finding the right source of capital based upon your circumstances. So there are other options on this last bullet. The Opportunity Fund, which I'll talk a little bit more about. There's a slide on it here soon. SBA Express, you've heard me made reference to that a couple times. We love that, up to $150,000. New start businesses qualify. You only need a 165 FICO SBSS to qualify. Instead, if we're looking for equipment or real estate financing, the SBA 504 loans might be a good fit. I've been involved with many of those. Private equity. Sometimes we need to get away from worrying about debt-based capital, money that we borrow that we have to pay back, and we may want to go to the equity markets, which includes private equity, angel investors, and venture capital. So purpose of this slide is to give you some tangible examples that there are other funding options available, maybe than what you were aware of before. There are some government programs for small businesses, including the SBA guaranteed loan programs. We work with you on these as well. This is important to understand that typically, in most cases, the SBA is not the lender, they are the guarantor. So they're guaranteeing repayment that reduces the risk to the lender. And there's many different types of SBA loans. There's, as you've even heard me mention today, there's the 7A Express up to $150,000, rapid turnaround, startups qualify, low credit score requirement of 165 FICO. The 504 you heard me mention, and here we're talking about microloans. So it's not your burden to learn all the different funding options that exist out there. We'll help you navigate through it, but hopefully you take from this great optimism that there very likely is one or more sources of capital that you can meet the criteria for either now or quickly. We can work with you to help you meet the underwriting criteria. Here, this graph on the up and down axes, it's called the y-axis or the vertical axis, shows financing options, and the bottom it says traditional to non-traditional. So a traditional financing option is going into your bank and getting a bank loan. That would be an ultimate traditional source. There's many other types of sources of capital. And then across the horizontal axes, called the x-axis, are different types of lending sources. And so what this graph is trying to show you is that there are different sources of capital based upon where you are with your circumstances. And what it also, I guess, is trying to subtly suggest is that going in and getting a traditional business loan can be difficult for an early stage business. And it doesn't mean it's impossible, but it's planting the seed, I suppose, that we may need to start to be more creative for financing solutions for an early stage business. And that's our expertise, so no worries about that. This graph shows different types of, or different sources of funding based upon the stage of the business. We work a lot with pre-launch and early stage businesses. We're going to define those as 2 years or less in business. And so down at the bottom, you'll notice it's kind of subtly states, banks and credit unions typically are going to start with mature businesses. And that's not a misrepresentation. In many cases, traditional lenders would like to see that you have 2 years or more of operating history and profitability before they consider you not too risky. There are some exceptions to that, but the most important thing to understand on this slide is there are a bunch of other sources of capital that we need to be considering that do not require that extra time in business. And most of these options, as you see, do not require advanced time in business. There's a small business financing checklist. We call it Exercise 2. It's page 27 in your participant guide. We'd like you to complete that. Either you can pause this now and complete it, or complete it after the recording, and then you'll review that with your financial literacy educator as you have your follow-up after today's lesson. Let's talk about improving your chances of getting a business loan. Because what we don't want to think is, well, it's just where I am today. Factors can change, and you can be actively involved with improving your access to capital. So what's one of the things we can do? And we talked about this in lesson 2, didn't we? We can work on strengthening your personal and business credit history. And that's not as difficult as you would think. Credit is fluid. It doesn't stay the same. It can get worse, but also can improve. And so that's one area that we may want to work on to improve our chances of getting a business loan. Now, with that being said, I've repeatedly stated this, not all sources of capital even look at credit history. But if we're trying to get a business loan, especially a traditional business loan, then optimizing our credit history makes a lot of sense. We've talked about many times, it makes sense we should be separating our personal and business finances. We need to understand and really embrace the 5 C's of credit. And we're going to talk about those again today. We talked about those last week on financial management, but I want you, if someone asks, well, what are the 5 C's of credit, for you to be able to recite them. So we're going to go through that again in a moment. And building bank relationships. We started this lesson talking about it is better to have a bank relationship where you know them and they know you than not. And so that can help our chances of getting a business loan. And then also we have the Opportunity Fund. I think I referenced once before. We do have a slide on it, and it is an alternative source of capital that's not credit-based. We'll talk about that here soon. All right, so furthermore, on improving your chances of getting a business loan, obviously personal and business credit history can make a difference on many sources of capital, not all. And it makes sense. I know sometimes if we find ourselves where our credit's not so good, we sometimes feel uncomfortable and feel mistreated, that they're judging us based upon what's happened in the past. But you have to understand, from their perspective, the lender's perspective, they just simply want to minimize their risk, and they want to be repaid, because that's the deal, right? If they loan you money, they want you to pay it back. And so when they look at someone's credit profile, personal and or business, and they've not been responsible, they've not done what they said they would do for whatever reason, they've not paid the bills back that they said they would, that means that you're riskier. And so we need to look at this from both sides of the transaction. So credit scores for some sources, not all sources of capital, will determine if you get approved or not, how much you'll get approved for, and what the repayment terms will be. Again, we have resources that can help you through that, so you're not locked in time of less than ideal credit if that happens to be your circumstance. All right, and so improving your chances of getting a business loan, you need to keep business and personal transactions separate, as we've talked about. We want to avoid commingling. We need to use QuickBooks or software similar to that to properly record our income and expenses. So many small businesses don't do that. If you need help with that, we can help you with that. But we need to run our business properly and have that type of software in place. You're going to need a CPA. Sooner or later, you're going to need to file tax returns at the end of the year. We need to have a CPA relationship, and that CPA may be able to even help you with the bookkeeping. But a CPA is going to help you proactively plan and make decisions to help reduce risk and legally minimize taxes, but certainly for the preparation. So a properly ran business includes having a CPA relationship. Other things we can do to improve our chances of getting a business loan, again, revolve around those dreaded 5 C's of credit. So we're going to go through these again. We talked about them last week, but they're too important to not recognize. But it's not just where you are, it's also what we can do to manipulate or improve our C's. So the first C is our capacity, our ability to repay a loan. Sometimes we call this cash flow, but we can't go ask for a big loan if we can't demonstrate that we have the cash flow to repay it, right? That makes sense. So for instance, if you and I went to a Ferrari dealership right now, we want to go buy a $500,000 Ferrari, $500,000 Ferrari. In addition to having credit worthiness, which is not the C we're on, we need to show that we have enough cash flow to be able to pay that, whatever it would be, $4,000 a month, $5,000 a month car payment. If not, we're not going to get approved, even if we paid all of our bills in the past. So capacity or cash flow is crucial. Now, we have an ace in the hole that's going to resolve that if that's a problem. And again, we call that the opportunity fund, so we can inject the capital into your business to show that you have the capacity. But we need to show that we have the capacity to repay a loan. Now you might say, well, I'm a brand new startup. How am I going to prove anything? Well, then it comes into play of a couple different variables. Certainly our financial projections that we put together are predicted future cash flow, and they may even look at your global income. So your global income would be income from all sources, not just this new startup or pre-launch business. The second C of credit is collateral. Now, again, remember, not all sources of capital require all 5 C's. That's not true. Not all sources of capital require all 5 C's. But we need to figure out what your strengths are so we can find the right type of capital based upon which C's you're strongest in. So the second C is collateral. Some, like we talked about UBF, unsecured business financing. In our experience, they don't ask for any collateral. So we've been able to work with small businesses and get them $50,000, $75,000, $100,000 with no collateral. But that's not true for other sources of capital, especially bank loans. So we need to keep in mind collateral. And that is what we're pledging that the lender could frankly take if we don't do what we say and pay back. Then there's credit history. How have we as an individual and or business fulfilled our extensions of credit in the past? Have we paid our bills on time? Conditions. Conditions mean what are we going to use the money for? What are the terms of the loan? What's going on in the business environment? So those are some internal but some external factors that can come into play. Like right now, the oil and gas industry, as of the time that we're recording this, is in a down cycle. So I know I was working with a client, had great credit, and we were working on buying some trucks for the oil industry in terms of frac sand operations. And so we put together the business plan, was working with the banker, and we were able to get an approval, but on a shorter repayment term. Now, this was prior to 2020, before the economic challenges we're facing now. But that banker knew that the oil and gas industry tends to go up and down, and they didn't want to have some long repayment term where it was more likely that the cycle would come down and then the borrower wouldn't be able to service the debt on those trucks because those trucks may not be earning income. So that was great insight by that business banker, because sure enough, that came to bear. So the business environment, as based upon your industry, can be a variable. And number 5 is character, your integrity, your reputation, your references, and I'll add to that, your experience. So some sources of capital do not care if you have any experience in what you're trying to do. But others, especially traditional business loans, which is what this lesson is more about, they care, right? So if you want to open a food truck, You might have heard me use this example before. We've had clients that wanted to borrow money to start a food truck. Well, great. Have you ever owned a food truck before? No. Okay. Have you been an employee? Have you worked on a food truck? No. Interesting. Have you ever been in a food truck? No, but I'm ready to start one. Well, that's going to make a difference in where we go looking for the capital, because a traditional business loan, you wouldn't pass the character test, not meaning that you're not a good person, but you have no relevant experience, where other sources of capital don't consider that. So you may want to rate yourself on each of these C's, to look at yourself realistically, objectively. How are you on your capacity, your collateral, your credit history, the conditions, and your character? Let's go ahead and talk about the Opportunity Fund for a brief moment, because this is going to be, I think, the golden ticket for many of you that come short on the ability to demonstrate cash flow. So our nonprofit IIMFL has been exclusively selected to administer the Opportunity Fund. The Opportunity Fund is going to inject capital into your business checking account, Well, what happens when you have extra money, let's say $10,000 a month, going into your business checking account? Well, now it makes your business look more vibrant, because at least you're on track, extrapolating out to be at least $100,000 a year gross income business. So cash flow, cash deposits, bank deposits into your bank account helps, right? It improves your capacity, your ability to service debt. It also can improve your bank rating. We haven't talked a lot about that, but how much money you keep in your bank, they look at a 90-day period, calculates your bank rating. And your bank rating could be a low 3, for example. So if you have an average bank balance of $100, for example, your average balance over the past 90 days, that's considered a low 3 bank rating. 3 because there's 3 digits in 100, and low because 100 is in the low end of 3-digit numbers, isn't it? If you had an average bank rating of a high 9, maybe that's like, a high 3, maybe that's like $900. So it's still 3 digits, but 9 puts you in the higher end. Move that on. So if you have a low 4 bank rating, as long as you've maintained at least $1,000 a month as an average daily balance, then that is considered a low 4. 4 digits, 1,000 is the low end of that range. In contrast, $9,000 as an average bank balance would give you a high 4. And that goes on into 5s, 6s, and so on. But the bottom line is, with the Opportunity Fund, by getting those deposits, ideally $10,000 a month into your bank account, it's improving your deposits, your capacity to borrow, your ability to repay debt, makes your financial statements look stronger, build your bank rating, and so forth. We built the Opportunity Fund off of the SCORE model. I used to be a SCORE mentor, and many of you are probably familiar with SCORE. It's a volunteer-based organization. So SCORE mentors are not paid. They're volunteers, and they usually contribute a few hours a week or a few hours a month to help other small businesses. That's how the Opportunity Fund was set up. So if you wanted to participate in the Opportunity Fund, you would do that. You would volunteer a few hours. It could be a few hours a week or a few hours a month. And what we're doing is facilitating financial literacy. We set it up on a budget, so you determine how much you're looking for, usually in 3 increments, $2,500 a month, $500 a month. 4 increments, $7,500 or the full $10,000. We like the $10,000 the best, but that's up to you. And so if you're interested in the Opportunity Fund, you'll visit with us afterwards, and we can work on getting that set up. All right, exercise 3 is the loan readiness checklist. It's page 36 in your participant guide, and we encourage you to complete that, and you'll be reviewing that with your financial literacy educator. Key points on section 2. There are different types of financing, including your own savings. Each has their own underwriting criteria. So it is unrealistic to think that you would qualify for every type of financing, but it's very realistic to think that we can find at least one that you do qualify for, or we can help you qualify for in the short term. Understand that there are different loan products and, as I mentioned, different underwriting criteria. There are some different government programs like the SBA guaranteed loans, which we're very active with and can assist you with. And then there's other types of non-traditional financing that tend to be a better fit for many early stage businesses, because the more traditional financing, the more likely they're going to look at all 5 C's. And so it's relatively difficult for an early stage business to meet all 5 C's, but we might be able to find one or more of those and be able to find alternative or non-traditional financing. And then also the Opportunity Fund is available to everyone. No C's required for it. All right, key points to remember. You can improve your chances of getting a loan by understanding your credit profiles and of course seeking to improve those. You need to understand the 5 C's. We need to have a plan to raise capital with recognition of where you are on the 5 C's. That's probably where the greatest frustration from small businesses will occur. They'll come to us and they're mismatched, they're unrealistic. They've not considered the 5 C's, where they fit, and what they're chasing for capital is inconsistent with the reality. Now, again, the good news is we can change those 5 C's and improve and strengthen them to create more and more and more and more funding options as we go along. But especially through the Opportunity Fund, we can guarantee anyone at least $10,000 a month in funding. So there certainly are solutions to everyone, but you're going to have to meet the underwriting criteria. We certainly want to maintain separate personal and financial business records. We want to prepare. We do not want to just go into the bank unprepared and say, here I am, I'm looking for some money. And we talked about this in an earlier lesson. They're probably going to ask you pretty quickly, oh, great, how much capital are you looking for and what are you going to use it for? And if we're not able to articulate very specifically and professionally the amount we want and how we're going to use it and how we're going to repay it, then that's kind of a black eye. We've had a negative first impression. So we want to prepare before we go get a loan. Now, don't confuse that we did encourage you earlier in this lesson to go meet with bankers, select a bank and a banker you want to work with, but that's separate from opening up the dialogue of, oh, I want a loan. See the difference? And certainly, if whatever your business model is not cash flowing very well, let's fix that before we apply for a loan in most cases. Because obviously, we talked about capacity. We talked about the ability to service the debt, cash flow. It is so much stronger to go apply for financing when we show that we're generating positive cash flow. You might say, well, that's not possible, Tom. I've got a brand new business. It's pre-launch. You guys said you can help brand new businesses get funding. Absolutely, absolutely. But it's even better if we can show that that early stage business has $5,000, $10,000 a month of deposits going into the bank account. That strengthens our capacity. That strengthens our ability to access capital. And so you have the ability to do that through the Opportunity Fund if you'd like. Resources, we talked about the small business financing checklist as well as the loan readiness checklist. Both of those are in your participant guides, singular. All right, in summary, if there's questions that you have, when we teach this in person, we would have this dialogue live, but otherwise you'll just visit with your financial literacy educator that's been assigned to you. We hope that you've learned a lot, and we'd love to visit with you about what you've learned and your evaluation of the training. There is an evaluation form that we ask that you fill out and give to your financial literacy educator. There's the pre and post test as well that's part of the participant guide. And we certainly want to implement what we've learned. That's our model, is not to just go teach a lesson, but teach a lesson and help you implement. So if you don't already have an appointment set up with your financial literacy educator, we need to do that. They're going to review with you the loan readiness checklist, and that's on pages 37, 38, and 39. We'll work on your capital match to figure out, based on all of your circumstances, where should we go for funding. And then if you want to get plugged into the opportunity fund, we can do that as well. All right, well, I know we've gone about an hour and 10 minutes, but this is a great lesson. This is the final lesson of the 4-lesson small business certification. So at this point, you'll get with your financial literacy educator, wrap everything up, you'll get your certificate of completion. They'll help you put together your capital match, and we'll go forward. So thank you all for your time. Please consider spreading the word. Let others know about the small business certification. Refer them to us, and you can even get paid for doing so. Thanks for your time, your effort, your diligence, and we look forward to helping you reach your potential. Have a great day. Bye-bye.